Welcome to another video about alter altitudes. Today, I'm going to be walking you through understanding the marginal income tax rates and how it impacts you during tax time. When you make elections on your W-4, that plays a huge role in how much withholdings are actually held from your paycheck on a weekly, bi-weekly, or monthly basis. However, what really makes the determination of what you owe or don't owe to the IRS is going to center around your marginal tax rate. While there are other components that factor into the ultimate calculation of what you owe and what you don't owe, marginal tax rate is going to be one of those biggest components. And my goal today is to help you understand what that means. And I'm going to focus in on your filing status today. This document has a lot of information on various different tax categories, but we're going to focus in on marginal tax rates. So draw our attention to table tax rates. This is what we're looking at to determine our marginal tax rates. And we're going to break this up into different filing statuses. There are four. There's married filing jointly, there's married filing separately, there's head of household, and there's single. And each of them has their own table on how they're taxed. The way that we're going to look at this table is it is broken up into different tax brackets. But the way that you read this is each number that we're looking at in this left column is going to dictate what portion of those dollars are taxed at what percent. This first line says every dollar up to $22,000 will be taxed at the 10% tax rate, which means that you will pay ultimately up to $2,200. This is going to say everything over $22,000, but not over $89,450 is going to be taxed at this 12% tax rate. Then the most we're going to pay in that particular bracket is $10,294. So you're going to pay this $2,200 plus the 12% of the value in between these two numbers, or up to a maximum of $10,294. As we continue to go up, in this next tax bracket, everything over $89,450, but less than $190,750 is going to be taxed at the 22% tax bracket. Look at the pattern. Every level, we're going to pay the previous bracket plus the percentage of the value in between those two. So let's look at this from a practical standpoint. So let's say we have a married couple with a household income of $150,000. What we're going to see is this $22,000 plus this $10,294 is going to be added together, plus everything above $89,450 up to $150K. What it's ultimately going to come out to is $23,615 is what we're going to owe for this particular bracket if our household income is $150,000. So now that we got that, I want us to pause for a second, and then we're going to compare filing status. So this particular bracket was for married individuals filing joint returns or surviving spouse that particular year. All right, so now we have married individuals who are filing separate returns, not over $11,000, files 10%. So the most we're going to pay in this bracket is $1,100. Okay, 1,100. What I want us to do is I want us to jump to that 150 mark. Okay, so once we get here to that $150,000 example, like we had in the other one, now we're at 24% tax bracket here. Now, once we do the math and add up all these brackets, what the married filing separately couple will owe after looking at all of this would be $29,400, which is how much more than the couple that's only paying $23,615. This household is paying $5,785 more in taxes just for their filing status alone. Hopefully, you all found some value in this video with just understanding how the marginal tax rates work. If you found value in the video, go ahead and give it a thumbs up. Leave some comments in the section below if you have any comments. I look forward to seeing you all on the next video. And remember, the only limits that you have are the ones you put on yourself. This has been Alter Altitude.